Okay, everybody, hello. Welcome to today's webinar. We're going to go ahead and get started so that we don't take up too much of everybody's time today. But, if in case anybody is joining late, we will be sending out the recording, or if you're having any issues like that. All right, so hello and welcome to today's webinar presentation. We're going to be covering a variety of topics today in an effort to provide an overall update on the international trade industry through the second quarter of this year. So things that are either currently happening or that we've seen happen in the last 3 months. My name is Meredith and I am your host and one of your presenters for today's presentation. If you are subscribed to our newsletter, you may recognize my name from our bi-weekly educational emails. Joining me today is Travis Smith, TRG's VP of Sales. Travis has spent the last 13 years talking directly to importers and helping them find solutions. And you'll notice our pictures there, that's us. My picture features some beautiful Montana snowy mountains, while Travis's features some trees in a nearby park.
Meredith, thanks for pointing that out. I promise to have a more dramatic picture for our next, maybe not promise, but I'll work on having a better Montana dramatic background for our next webinar.
We have to be on theme because, of course, this webinar is being presented by Trade Risk Guaranty, or as many of you know us as, TRG. Our headquarters are located in Bozeman, Montana, and we have been providing U.S. customs bonds and cargo insurance solutions directly to importers since 1991. This direct-to-importer business model is unique to the international trade community since it cuts out the need for an additional middleman and allows TRG to become another member of your international trade team. Now, we will be recording this webinar and it will be available on our YouTube for future reference. If you want to be notified the moment it releases, I highly recommend you subscribe to our YouTube channel. We also post additional educational videos on YouTube about once a month to maybe every other month. So if you're not already, I would recommend that you subscribe there. You can also find us by searching Trade Risk Guaranty -TRG directly in YouTube. A link to subscribe will also be sent out with the webinar recording as a follow-up to today's attendees. Now, please submit your questions in the question box in the webinar interface throughout this presentation. We will be answering as many as we can at the end. However, if you have any questions during the presentation and we're not able to get to them, still submit them via the questions section of the webinar interface. The questions submitted during the session will be reviewed and then answered shortly after the webinar. And of course, as a quick reminder, this presentation is for educational purposes only and does not constitute legal advice. All right, so I'm going to go ahead and pass the mic over to Travis, and he's going to start us off.
Thanks for that introduction, Meredith, and thank you everybody for attending. We're hitting on a bunch of topics, about 4 different topics in this webinar that we feel are very important to the trade industry, but maybe aren't getting the attention they deserve in the internet, in the general world news feed. And we're going to jump right in and first talk about possible strikes impacting the U.S. Now, before we go to the next slide, let's first take a minute and look back and recognize that the West Coast port workers, all the way up and down the north-southwest coast of the U.S., were working without a contract for a very long time. There were brief work stoppages. There was never a strike, but over the past month, news has come out that the Teamsters and the ports have pinned a contract. So they have a contract in place. It hasn't been signed. It hasn't been finalized yet. But the West Coast port strike that was possible, it seems like that's off the table. And then one that is active, we have UPS. As of August 1st, the UPS contract with their workers will expire. And this is a big deal. The Teamsters Union represents 340,000 UPS workers. That's over half of the company's workforce. And what do the Teamsters want? Why do they feel they need a more robust contract? Simply, they worked through the pandemic, and in my neighborhood, we had those UPS workers showing up way after dark throughout the pandemic. We saw unprecedented demand for small package delivery, which certainly stressed those individuals working. And the UPS labor workforce is saying, hey, we deserve a better contract. And specifically, they want to see better wages for their part-time workers. UPS workers are arguing that those part-time workers are working at very, very low wages, and they want to see those wages increased with this new contract. Now, the impact that this would have on everybody on this webinar, as well as the U.S. economy, would be dramatic. Last time we saw a strike like this from UPS was way back in '97. It impacted the U.S. economy back then, and back then there were fewer small packages being delivered. Now we're seeing 24 million packages on average per day being delivered by UPS. And to take a step back and look even deeper into this, if you're following interviews or the Twitter feed, if you're on Twitter, from, I think the guy's name is Chris O'Malley, the Teamsters newly minted president of the Teamsters, he's not backing down, and he's very aggressive in saying he's not bashful at all, and saying they're ready to strike if UPS doesn't come to the table and deliver on a better contract for the workers. Now, you're sitting there in this webinar, what do we do? How can we prepare? Of course, you got to look at other service providers. There's FedEx, U.S. Postal Service, Amazon, DHL. Amazon has come out and saying that they have additional capacity. They work through their own trucks for the last mile network, that last mile delivery. FedEx has been a lot more aggressive in saying they're a non-unionized workforce. They have excess capacity to a certain extent. If a strike does happen, they're going to service their existing clients, and they might not be able to take on that additional business that would come asking for services after the strike, if the strike goes into place. So FedEx is being very aggressive in trying to capture some business from this situation that UPS is in. And on this possible UPS strike, we don't have a slide dedicated to this, but Yellow Freight, a massive domestic LTL, FTL trucking company, has sent news out saying that they're in a bad financial state. They're also needing to renegotiate some of their contracts with their labor workforce. Now, again, Chris O'Malley, the Teamsters president, has been very quick to come back and say, hey, we've negotiated with you in the past. If you're needing to figure out your finances, that's on you. We're not going to figure it out by renegotiating our contracts. So that's another service provider in the freight world, Yellow Freight, that could potentially experience some disruptions and maybe even a strike in the future.
Yeah, and just to kind of further what some of these other service providers are saying, so the Postal Service has said that they will accept all packages tendered to it as long as they are within the normal weight and size limits. So, that is another potential option as well. FedEx is obviously being a little bit more aggressive, saying that they will prioritize their current clients, but there are some other options that, you can start to look into.
And then Meredith, that's a good point. UPS hasn't come out with a formal backup plan if there is a strike, but I think what they've said, and this doesn't provide much comfort, is that they're going to prioritize high priority shipments and high value shipments. So the more you're spending with UPS, the better chance you're going to get attention. That doesn't provide much security.
Yeah, they have stated that they will do that using non-union employees. So that is a difference from what happened in 1997. In 1997, UPS completely shut down. I think it was for about 15 days. Currently, UPS is stating that they will not completely shut down. They will try to keep things moving with their non-union workers.
And then in addition to the situation we have going on with UPS and Yellow Freight, there is an active port strike happening up in Canada. And how does that impact US importers? You know, we speak with US companies all the time who bring in goods through primarily West Coast Canadian ports, and then they truck them or rail them down to the US. So we're looking primarily at the Port of Vancouver and the Port of Prince Rupert. We're already seeing service providers trying to re-navigate ships to US ports. We've seen 2 ships that were destined for those 2 ports bounce off those ports and come down to US ports, but the labor workers down there said they won't unload those boats. So this is going to impact the US, and there hasn't been an end to this strike yet, so we're keeping a close eye on that. And then here we say, you know, just again, service providers are struggling to reroute the ships that are destined for these Canadian ports that are on strike. If you do regularly ship to Canada, or you're thinking you might have shipments a month, 2 months, 3 months from now that'll go through Canada, you got to address this and adjust your shipment. And then for an update on Canadian customs bonds, I'm going to hand it over to Meredith.
Yeah, so we thought we should kind of include another quick little update on Canadian customs bond in this presentation. Now, this has been a topic that we have discussed more extensively in its own webinar. I believe it was our last webinar 2 months ago. So if you're interested in more detailed information specifically about what's going on with this Canadian customs bond, please, I would recommend to go watch that past webinar. We also are planning on having, it is live on our YouTube, so you can go watch that as soon as right after today's presentation. We also do plan on continuing to put out more stuff as information becomes available and as deadlines start to creep up on us all. Now, what is the big date we all need to worry about? So the big date is October 2023. That is when CARM Release 2 is set to go live. So US importers that also import goods into Canada will be subject to the changes coming with Release 2. And these changes include the following. This is kind of their official statement, so I'll go into a little bit of that. But Release 2 will expand the functionalities of the CARM client portal. It will add some electronic commercial accounting declarations with the ability for corrections and adjustments. So you'll be able to get into the CARM client portal and do those directly in there, as opposed to having to file additional paperwork, manually. The new requirements related to the release prior to payment program. Now, this is the big part that we are talking about the most. This is the part that specifically talks about Canadian importers needing to have their own release of goods bond. And you'll notice there, I'm using kind of 2 terms to talk about this bond. In conversation, we call it the Canadian customs bond. That's kind of what everybody is, the shorthand we're all using. But officially, this bond is referred to the release of goods bond. And that's because it directly has to do with the release prior to payment program. I'm not going to go into too much detail about that and that program now, because we did cover that much more in our past webinar. But that's really the big part. So this requirement to have this bond on file is going live in October 2023. Now, some other changes that Release 2 will bring is some changes to their harmonized billing cycles, basically how those are filed, some new offsetting options, and then electronic management of appeals and compliance actions. So again, all of this will be within that CARM client portal. So what can or what should you do now? Well, right now, you should sign up for that CARM client portal. That's really the first thing businesses that import into Canada need to take care of. Canada Border Service Agency, CBSA, they're really focused on ensuring that importers are set up in the CARM client portal as soon as possible. The Carm Client Portal launched as part of Release 1 back in May of 2021. Every Canadian importer must register and access the CCP, Carm Client Portal, to be eligible to import goods into Canada. Registration should be completed before Release 2 to ensure no interruption to your importing process. Basically, if your business is not signed up for the Carm Client Portal, they basically don't exist in the eyes of CBSA. Now, there is some good news for those of you that are not quite ready to place that Canadian Customs bond today. Canadian importers that have registered for the Carm Client Portal prior to Release 2, they will have a 6-month grace period after Release 2 to get their release of goods bond in place. So you would have an additional 6 months to get that bond before you begin getting penalized. So that is something to consider. Just another reason why you should sign up for the Carm Client Portal as soon as you can. If you are interested in putting that bond, getting that bond in place even earlier, that is something TRG can help with. By all means, reach out. We'll be sending out a follow-up to this webinar. You can always respond to that, or we'll have some contact information at the end of this. And reach out, and Travis will probably call you up and discuss your needs and kind of help you through that process. All right, so now I'm going to go ahead and pass the mic back over to Travis to discuss some more updates within the international trade industry.
And the next topic we're going to talk about is container pricing, just moving the container from overseas to the US. This has been a great source of relief for many TRG clients and really everybody in the US economy and in the US. Container prices have dropped to the very low point. Really, we're probably not going to see the rates drop much lower. We don't know how much wiggle room there really is. Possibly if you're a BCO, a beneficial cargo owner, if you're negotiating directly with the steamship line, there is a lot of excess capacity, so you could leverage your volume to get a much lower per container cost. Now, if you're doing that, make sure you look closely at the contract and make sure it's not only beneficial from a cost perspective, but the terms of the deal put you in a good spot. And what this means for the importer, for the companies, of course, you're saving money. Not only that, but a lot of freight forwarders, customs brokers have excess time on their hands. They're looking for more business. They're knocking on doors. They want to negotiate and prove they can be a good service provider and a partner for your company. So it's a good time to shop around. Also, if we're not only looking at the cost of moving the container, but some ancillary fees that go with it, that's a point where maybe prices haven't come down from the pandemic. When I speak with my clients, a lot of them are being quoted pretty high prices for the importer bond. A lot of new importers or a lot of importers that are coming back into the game are being quoted around $600 or $650 for the normal $50,000 importer bond. That's pretty high. Before the pandemic, it was around $500. So that's an ancillary fee that went up during the pandemic and maybe hasn't come back down. Everybody's eyeing that container freight cost, but these other ancillary fees are still high. Of course, a quick plug for TRG. Our price point for the $50,000 importer bond is much lower than that. You can get a 1-year introductory rate for just a little more than $300. So if there's room there for you to save money on the import bond, please give us a call. We also have multi-year terms that can get it down to as low as $225 a year. Another ancillary cost that I feel has really gone up, it really went up over the pandemic and it's staying high, is per shipment cargo insurance. If you ship internationally, you're not required to have cargo insurance, but it absolutely is a good idea to have cargo insurance. God forbid something happened. Now, before the pandemic, you would see per shipment insurance rates at about 0.2% at the very lowest rate, up to 0.6%. During the pandemic and even current day, when I talk to importers, a lot of them are being quoted rates at 0.6% or even higher. That's pretty dang high. So if you are insuring per shipment, First thing you can do is look at your per shipment rate. If it's above 0.5%, then there's likely a lot of wiggle room for you to save some money and negotiate with your service provider to get that lower, closer to 0.3%, or maybe even a little bit lower than that. Of course, if your volume, if you ship enough, you should be looking at an annual policy as opposed to per shipment insurance. Generally speaking, if you ship more than about $200,000 value of goods a year, then you should be looking at an annual policy. But those are two ancillary fees that seem like they've stuck high and they could really come down. And then on top of that, on top of talking about container prices to move the freight, we are still seeing a lot of push from the US government on forced labor enforcement. Now, we talked extensively on this topic when the UFLPA, the Uyghur Forced Labor Prevention Act, was put into place. One of our previous webinars, we teamed with a company called FloraTrace, and they're a group of scientists that have actually implement a way to trace goods back to their raw material and see where they came from. So this can absolutely be applied. If you're a company that's worried about your goods being held up due to UFLPA, you should reach out to FloraTrace, review that webinar we have on our YouTube channel with FloraTrace to become familiar with them, and give them a call and see if they can help you. Throughout these next couple of slides, you'll get a good feel as to whether or not you're kind of in that target demographic of importer that might be affected by the Uyghur Forced Labor Prevention Act. But two new bills that are working their way through the government right now that again deal with forced labor enforcement are the Countering China's Exploitation of Strategic Metal and Minerals Act and the Child and Forced Labor in the Democratic Republic of Congo Act. So, you know, we're seeing more and more movement by the US government to get tough on exporters that participate in forced labor, or countries, or that realm of use of labor. Everybody can agree it's bad. At the same time we're seeing these bills, we've also seen over the past months 3 meetings between US high-level representatives with China. Most recently, Janet Yellen was over in China for a meeting. Now, that's a sign that diplomacy is happening. And that's a great thing to see. So China's taking note of this more aggressive stance by the US government. At the same time, we're negotiating with them, and we have diplomacy happening, which is good to see. And if we look specifically at the UFLPA and how it's impacted importers since it's been implemented, we are seeing an increase in stopped shipments under the UFLPA. May was up from April. Over 42,000 total shipments have been stopped under UFLPA. 37% were released, 15% denied, 46% are still pending. So that's a lot of stuff to be sitting there pending. The government's got to resolve these pending shipments, because if they aren't truly a shipment that has to do with the Uyghur people, then it should be entering the US, and those companies should not have to stress through this, through a type of holdup like this. 37% of stopped shipments have been from China, 31% of stopped shipments from Vietnam, 30% of them from Malaysia, so all originating from Asian countries. And then you're looking specifically at denied shipments. And this is where you can get a really good idea of how much maybe you really need to be concerned with the UFLPA. A lot of it, almost 50%, is of denied shipments has been for apparel, footwear, and textiles. Another 24% industrial manufacturing materials, and 14% are pharmaceuticals, health, and chemicals. So if you're in those industries, you really need to be paying attention to the UFLPA and your supply chain. 66% of all shipments that were denied were from China, and then it drops off quite a bit, 32% from Vietnam and 2% from Malaysia. Apparel, footwear, and textiles, again, if you're in that industry, you can't ignore this. 47% of shipments from China have been denied, and 56% from Vietnam. So that gives you a good idea of where you stand. If you're not importing from China, maybe you don't have to worry about this as much, or from Asia, maybe you don't have to worry about it much at all. And then those specific industries that we just went over, you really have to be thinking about this. And then moving from forced labor, this is a topic that really hasn't been in the mainstream news at all, but likely the reason it's not in the mainstream news is because international container freight volume is down. But there's a drought in Panama, and believe it or not, that's resulting in limited cargo that's being able to go through the Panama Canal. Now, we can't have a discussion about Panama Canal delays without going back and thinking about the ship that got stuck sideways, the Ever Given, in the Suez Canal. Now, that happened at a point where international freight was at its peak, and it got a lot of attention. Now we're looking at the Panama Canal, you know, and from these two canals, they're nicknamed the ditch and the trench. The technology behind them isn't that advanced, and maybe this Panama Canal event is just a soft reminder that the technology used to keep water in the canal, to keep this vital transit way open, needs to be revisited and supported some more. Now, with this, we're seeing carriers imposing $300 up to $500 per container fee for containers going through the canal. That's a big thing to keep an eye on. That makes your landed costs a lot higher. And then just looking specifically at the Panama Canal, the US is the biggest user of the Panama Canal. 40% of all US container traffic travels through the Panama Canal every year. You know, there are ways to get around it. You can go through the Suez Canal or take a journey around the Africa's Cape of Good Hope, South Africa's Cape of Good Hope, but that's going to take a lot longer. So, you know, we're not never going to see a drought again. So the thought is that the canal has to address this and provide better technology to protect against this in the future. So the impact on importers, you need to be eyeing this. Again, I don't see this topic talked about much in the mainstream media, but if you're a shipper that brings goods through the Panama Canal, you might see additional fees, so your landed costs might be higher. You might experience delays, and that it totally impacts your supply chain. And anytime you see a disruption in the supply chain like this, like a major waterway limiting its capacity, that increases the chances of errors or mistakes happening, like we saw in the Suez Canal when there was high volume through there and the ship got stuck sideways. Now, you ship internationally. We mentioned cargo insurance a couple slides ago. Keep in mind, cargo insurance does not cover delay. So if your goods are delayed and they don't arrive in time for your client to purchase them, that's not a cargo insurance claim. Cargo insurance covers if the goods are lost, stolen, or damaged. So you want to keep an eye on this. You possibly have business interruption coverage through your general business provider, which may be something to revisit if you ship through the Panama Canal. But these are all important things to think about if you ship through the Panama Canal. And this could stress all of the US ports if the canal really experiences more drought.
Okay, so we're going to go ahead and open up the discussion to questions. So please submit any questions you have in the question box in the webinar interface. You know, feel free to ask about any of the topics, or if there's another topic we didn't cover. If we're not able to directly answer that now and need to like look into something a little bit more, that is something we can address after the webinar, so we can reach out more directly about those things. So please submit those questions while we kind of give you guys time to type them out. Travis is going to go ahead and talk a little bit about TRG while those filter in.
Yeah, folks, you know, TRG, we've been in business since '91. We think we're a great alternative to maybe some of the more mainstream avenues of securing your U.S. Customs importer bond or cargo insurance. We've also been writing a lot of cyber liability insurance as those events have ticked up in the world and companies are demanding standalone cyber policies which provide more robust coverage. You know, we generally have very competitive pricing on the import bond. We feel we provide customer service from a different angle and a different perspective that you might enjoy more, maybe a little more personalized. And on the cargo insurance, if you ship internationally and your volume is over $200,000 worth of goods a year, give us a call and see if we can write you a policy that fits perfectly with your needs.
Okay, so we have received one question here, specifically about, the question is, what is the outlook on GSP? There are a couple different types. I'm assuming GSP, you're talking about the General System of Preferences, which are relationships between the US and countries, basically to promote importing from those countries into the US. This was something we touched on in our last update.
Yeah, Meredith,
basically talking about, oh, go ahead.
Yeah, we jumped into it pretty thoroughly in our last webinar. And, you know, the thought and the outlook was that it's a topic that the government could get together and pass to reinstate it because there is so much concern over China. The GSP is a real natural, real obvious way to keep trade between US and developing countries healthy and moving forward. Unfortunately, we didn't mean to set the sights too high in that previous webinar, but the feeling is that each party in the government is trying to tie their own concerns to the reinstating of the GSP. So the one side wants to do it with other pork or other stuff they'd like to get in place. The other side has their bills they'd like to get in place, and they're all tying it to the GSP, so they're not meeting in the middle and just getting GSP reinstated. So that's a major pain point for the US economy and overseas potential trading partners. But unfortunately, we haven't seen any positive movement on that to get it passed. But we're keeping a close eye on it. And Pace, thanks for the question.
So another question we got is about the Canadian Customs Bond. This one is release prior to payment, is the release prior to payment bond required for importer records to have for all goods going into Canada? And I didn't really touch on this on my slides. The short answer is yes. For the most part, the majority of importers importing goods into Canada. So that is if you are a Canadian citizen and you're bringing goods into Canada, or if you are a US-based business and then you import goods into Canada, you are going to need that bond. However, if your business chooses not to participate in the release prior to payment program, you will not need that bond. Again, I didn't really get into that program specifically, but just as a really short explanation, that program allows importers into Canada to basically release their goods immediately and then pay their duties after those goods have been released by CBSA. If you do not want to take that route, if you would prefer to just pay your duties for every shipment when they arrive in Canada and not kind of defer that payment, you can do that and you would not need to have that bond on file for that. However, you know, if you do this, obviously there is the chance that your goods are going to be held at port for longer while they wait for that payment. You know, there's just a greater chance for delay. But that is an option, especially if you're a smaller importer that, you know, you don't really want to deal with having a bond or placing a cash security, things like that. Okay, well, those are the only questions that we've gotten today. If you have any others, or if after this webinar, you know, you get off and you decide, or suddenly a question pops into your head, by all means, you can reach out to us after the webinar. We love receiving questions of pretty much any form. Makes us learn something, right, if we haven't looked into that yet. So thank you for taking the time today to attend our webinar. If you do have any further questions, don't hesitate to reach out to either me directly at marketing@traderisguarantee.com. Also, if you would prefer to reach out via, LinkedIn or any other kind of social media, feel free to chat us there. We do love receiving any kind of questions through LinkedIn. It kind of allows us to address them a little more personally. Additionally, check out our blog at traderiskguarantee.com/trgp. It's got a treasure trove of excellent articles and information. And don't forget to find us on Facebook, Twitter, LinkedIn, and of course, YouTube. We will be sending out a follow-up email tomorrow with any links from this presentation, as well as with the recording of this presentation if you'd like to watch it again. Again, thank you for attending the webinar.